Hello and welcome to episode number 9 of Policy in Wonderland. I'm your host, Evitar Amira. You can call me Evie. In Policy in Wonderland, just like Alice, we are going to explore and see the wonderful world of insurance, insurtech, and everything that's connecting to this amazing ecosystem. In Policy in Wonderland, you will meet startups from all over the world, key figures, insurance brokers, and more. So without further ado, we travel today to the States, and I want to invite my guest to join me as we go down to the rabbit hole. Please welcome insurance broker. Hello, my friend. Thank you for joining me today.
Of course, thank you, Aviatar. How are you?
Fine. Great. Um, so you're like Elon Musk on Twitter for insurance, if I can say that. Yeah?
I don't know if you're allowed to say that, but I guess I'll take, if it's a compliment, I'll take the compliment.
Yeah, go ahead. So today we are going to talk about a couple of, for me, the very interesting thing in insurance is called captive insurance, ENS, admitted self-insurance, and a lot more. And for me, this episode is like going to be one-on-one insurance. Um, but before we jump in, can you start by giving us a brief introduction about yourself?
Sure, and thank you again for having me. It's really a pleasure to be here, and I've enjoyed all of the conversations and connecting with you through Twitter and the internet. Um, I started my career in investment banking, totally unrelated to insurance, had no interest in going into insurance. I think most people say that they never expected to be in insurance, and somehow the bug caught me just like everyone else. I was introduced to a family office that had a few different insurance entities and operations that they were running. They were looking to start a commercial brokerage, so I partnered with them to start a commercial brokerage. I ended up leading a risk retention group on their behalf.
Hmm.
We had a workers' comp carrier
So you,
that I did pardon?
so you started from the worker compensation side, like.
I started really from the brokerage side.
Mhm,
Then through the brokerage, a few tasks that I was asked to handle ended up me turning into me leading the risk retention group. And
mhm.
we can get into what a risk retention group is in a bit.
Yeah.
Um, and then at the same time, some strategy items for workers' comp carrier. Um, and we had a bunch of captive entities, offshore and onshore, that I oversaw and set up a few programs and did some capital allocation planning for those carriers and the admitted assets. And that was like all the carrier side, the back end
Mhm.
side that typical distribution insurance brokers, wholesalers don't see. So it was like really interesting and to kind of get that perspective. And I enjoyed it because it kind of played into my experience in corporate finance and investment banking was really, operating the underlying risk retaining business. And I left the family office. I left my relationship and I went off on my own and I continued brokering commercial policies, doing captive advising and consulting. So I took a lot of what I had learned on the captive space from overseeing the captives and running a risk retention group, which is based out of a captive. Um, and I took that kind of into the advisory and intermediary space and did a lot of focus on that and brokering, fronting, and reinsurance for MGAs or MGUs, programs, carriers. Um, and that's kind of where I find myself today.
So before we dive in, what is the retention groups,
So risk retention group. So the
please?
Risk Retention Act was a federal act put into place, which allowed for the um, pooling of liability risks. Let's call it that for simplicity purposes. So risk retention groups are basically they function as a carrier to a
Hmm.
certain extent, kind of like a mutual carrier, right? So you have stock insurers and mutual insurers. A stock insurer is owned by its shareholders, and a mutual insurer is owned by its policy holders. So it's kind of like a mutual carrier, um, where you have all these different groups that kind of that they basically it allows for more flexible insurance structures. You can have different retentions or deductibles. Rate approvals are a little more flexible than a traditional carrier may be. But ultimately, they all own the risk together. So if something were to happen and there were catastrophic losses across the entire portfolio of risks, there could theoretically be an assessment or additional premium that needs to be paid in by each policyholder because they technically are shareholders in this group together.
So it's like a syndicate, or you just mentioned a mutual insurer or mutual carrier.
It's not a syndicate. It's it's kind of like a risk pool. They're all sharing in the risk together.
Mm,
Right. So a
yeah,
syndicate
makes
or
sense.
risk purchasing group might be where you have a bunch of different carriers coming in to insure an individual risk, right? Also on the liability side, typically you'll see risk purchasing groups or RPGs, but risk retention groups or RRGs are kind of the opposite, right?
Mhm.
You have this one carrier, but many different risks kind of sharing together for that pool.
So let's talk about captive insurance. What is captive insurance? Because we know as the business owner, the personal people, is the regular people, know that I have a carrier insurance company. Okay, I pay the premium if I connect it to my broker, to my agent, and they gave me my policy, and then I have a coverage for all the risk that I assume I have a decent coverage for my risk. And then you said, wait, I have another kind of insurance that's called captive insurance. What is captive insurance?
Yeah, it's a great question. It's kind of the wild west and unknown world of insurance that people haven't heard of, but have no idea that it plays such a big role in their lives to a certain extent. So captive insurance is really, I don't think there's actually a true legal definition even, but captive insurance is a captive insurance entity is an insurance entity owned by a parent company to insure itself, right? So taking
Mhm.
a step back for a second. So an insurance carrier is just a risk-bearing entity. It's an entity that has a license to write insurance business that I pay premium to. They offer coverage back to me in exchange for that premium and whatever the predetermined limits of coverage are. An insurance carrier is a third party. A captive is essentially taking that third party and making it first party in its simplest form, right?
Okay.
So the 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 simplest definition is I have a parent company. I want to insure a portion of my risk internally, first party. I open up a captive entity and I insure myself through that captive entity. Now, I believe there's 27 to 30 domiciles or states that allow and have regulations for captive insurance, right? So not every domicile, so insurance in the United States is regulated on a state by state level. It's not federal, it's state by
Federal, yeah.
state. So not every state Department of Insurance has a captive division or allows for the
Mm.
setup of captives in their domicile in their state. So I think it's 27 is the last I checked. There's also a bunch of offshore domiciles, Bermuda, the Caymans, Virgin Islands, etc., that all allow for the formation of captive insurance entity. They have captive insurance laws. And so in its simplest form is to take a portion of my risk from the commercial marketplace and hold it internally. Yeah, please.
But okay, if I will do that as a company, as a business owner, so I need to get a risk management consulting or in-house or outsourcing. Um, why why do I need captive insurance? Because I have insurance carriers. Why do I need this kind of mutant, if I can call it?
It's a good question. So commercial insurance um, has a time and place and has a point beyond which it is no longer capital
Sorry,
efficient.
sorry. We talk about captive insurance also in the personal lines, commercial lines, all lines of insurance, or any specific lines in insurance?
Typically, you'll see it in the commercial space.
Okay.
There are ways that you can structure a captive to insure personal lines,
Mhm.
but it is more complex because of regulations around personal lines. Um, and you'll typically need a fronting carrier by default to do anything in the personal line space, unless I stand corrected. And we can get into what a fronting carrier is later down the line.
Yeah,
But
yeah, yeah, we'll do that.
but regardless, right? Just, from a kind of just a fundamental standpoint, right? When I'm paying an insurance carrier to take on my risk, to have my liability of risk, there's a point at which it's no longer capital efficient, meaning to say they either don't know how to underwrite this risk, they don't have the collateral or capitalization to write my risk, they don't have the facilities to take on my risk, whatever it may be. There's a point at which it may no longer be capital efficient, right? And that could just be from a cost perspective,
Mhm.
or that could be from a losses perspective, right? And when I say cost perspective, I mean pure upfront premium, right? That
Okay.
could be that the amount of premium for coverage I'm paying is doesn't make sense, right? Or it could be that even though I might be paying a reasonable premium up front,
Mhm.
my losses, my history, my claims experience is performing really well. And why do I want to allow a third party to make money off of my policy, off of my risk, if I am in control of it and I can make money off of it myself, or if I can control it myself, right? And so it's not for everyone. In fact, it's probably not for most, right? But there is a group of people out there that are spending both enough in insurance and their risks are performing well that it does make sense for. I think the statistic is that over 90% of the Fortune 500 companies have some sort of captive in their insurance program.
In a way, it kind of makes sense because, first of all, if you want to have captive insurance or you need to captive insurance, you will ask yourself who will know much better about my business if it's the owner himself, it's the company itself. And as you mentioned, I will not deliver the premium or the fees for a third party to manage my risk. I know much better how to manage my own risk. Um, and for me, right now, as you mentioned, the premium or the risk management, while I have captive insurance, is right now we have raising cost of insurance all over the world, especially in the US, even here in Israel, Europe. And we see that in California, we see that in Florida, all over the place. So you said captive insurance is not for the most, but right now, if I can maybe think about it, it could be for most of the people right now. It could be much more relevant for many commercial business right now. You don't think?
So, yeah, so it's a fair point. The reason why it's not for most. So it's a fair point, and the reason why I say it's not for most is because to it even be a consideration is there you have to be spending a certain amount for it to be a capital efficient solution as well, right? There are costs to setting up captives. There's costs to the ongoing management and services that are needed to be provided for a captive and claims handling, right? That you typically don't see your mom and pop business on the corner of the street is not spending that nearly enough money to be worthwhile, right? So on the low end, you'll see captives that are funding a couple $100,000 to $500,000 in
Hmm.
premium. Um, but truthfully, where it becomes a really good solution is for those businesses spending $1 million plus in insurance premium in the commercial marketplace. And that's because every insurance carrier, whether it's a captive or whether it's a commercial carrier, has expenses. They have overhead, they have underwriting costs, they may have reinsurance fees, they have licensing fees, they have taxes, boards and bureaus, all of these different things that add up. And so you need to be basically above a threshold where you're not spending more in expenses than you were in premium beforehand, right? For it to make sense for you to open up a captive. But now that rates are punitive or that they're ever growing and accelerating and sometimes being a little bit borderline ridiculous, you're seeing many more groups think about captives and when they weren't beforehand. And it wasn't because they weren't necessarily spending more enough money beforehand, and that is true for some. Their threshold of where they were spending what amount of premium they were spending wasn't there. But now it's because that shift in their mindset of offloading risk to retaining risk has kind of come through as they understand more about insurance and why their premiums are increasing. And insurance is this global ecosystem that few truly understand all the different parts and parcels of it, but it's all interconnected and ends up impacting everything else, right? So it's very hard to have a good understanding of insurance and captives and what am I paying and why am I increasing and all these different things if I don't understand the entire insurance ecosystem. And few truly do.
But if I have right now insurance agent for my moms and pops, I agree that moms and pops is not for captive insurance. But if I have insurance agent, okay, I will take insurance broker, I will take risk consulting to manage my captive. This does not make sense or not.
It's
Uh,
n it's not really how it works, right? So
okay.
typically the ecosystem of captives is that there's captive managers, right? So you'll have an
Mm,
intermediary,
okay.
right, who's independent, who's not partial to any specific captive facility or domicile or captive manager. But typically the conversation will start with the captive manager, and captive managers will usually have what's called an administrative core or a captive facility in different states and different domiciles
Hmm.
that they can then open up cells, protected cells, unprotected cells, all these different structures that captives find themselves being able to be opened up in under their branch of the umbrella of their facility. And then through that, they're able to provide management services. So they'll do the ongoing accounting and the taxes, and they'll have legal services that they can be provided through a third party typically. And then they'll have investment management, and then they'll have maybe relationships with banks and TPAs, third party administrators, which handle the claims, right? Your
Hmm.
typical risk manager or insurance agent is not really part of that ecosystem. There are groups that will have their own internal risk management system, right? That might be sufficient,
Hmm.
but that doesn't cover all the pieces of the puzzle, if that makes sense.
Yeah, totally. Okay, so I know that there is also self-insurance, and there's a difference between self-insurance and captive insurance, right?
So self-insurance you can kind of view as the overarching theme, and captives are one way to accomplish a form of
Hmm.
self-insurance. So self-insurance isn't necessarily as daunting or as intense as it seems, right? When people hear self-insurance, they literally think that you're just not spending money on insurance and praying to God that no claim happens that year, right? Which is unfortunately what some people do, but that's not what it's really intended to look like, right? So what we call it really is more alternative risk transfer or alternative risk financings. It's different ways to finance or transfer risk than the commercial marketplace. And the commercial marketplace is just one way to transfer or offload my risk, right? You can do financial hedging. There's other ways to finance risk other than just commercial policies, right? So when we think of self-insurance or alternative risk transfer, there's that person that's just not going to pay for insurance
Mm-hmm.
and pray that they don't get a claim. There's the person that will open up a trust or a savings account that they'll put money into to build up over time. And then then there's captives, but that it doesn't have to be an all or nothing. Typically, a captive will fit into my greater insurance program. On the on the casualty side, I may take a portion of my risk or certain risks into my captive, but let the rest remain with the carriers. For my property, I might split up different layers of my risk or take a
Mm-hmm.
deductible in my captive. All these different structures. It's not just me going bare without insurance. It's there is risk mitigation theory here. It's just an alternative way to go about it.
I want to talk also about ENS and admitted. While I traveled in the States, I got to know it much better that I have admitted companies and not admitted companies. And the structure is very, very important for also for insurtechs, but also for insurance and commercial business owners, because not my business cannot be only for admitted or regular insurance carrier, but also for non-admitted. So what is ENS? What is admitted?
Yeah, that's a good question. And so to answer the question as it truly deserves to be answered, we have to kind of take a step back. And so when we say insurance carriers, an insurance carrier is really just a licensed entity that has the ability to write insurance business. It is nothing more than that, right? You can just think of it about a shell company that has a license attached to it that can now write business. However, um,
Right.
insurance companies own insurance carriers, right? So, for example, Travelers will have probably 50 to 100 plus insurance carriers that they own, that they either applied for licensing for entities that they set up or bought shell companies that they set up. Now, the licensing of insurance carriers is done in the resident state or its domicile, and
Mm-hmm.
then you get licenses in each additional state after that. An admitted carrier is a carrier that 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 abides by the rates and the regulations of a certain domicile or state. There is rate and form filings, they're called. They have to apply with certain rates and have actuarial basis to underwrite at those rates. There's all these different applications and filings that they have to fill out. There's taxes, et cetera, et cetera, et cetera, that if they subject themselves to that, they are called an admitted carrier.
Can you give me
Admitted carrier.
examples of couple of admitted carriers?
So Travelers has numerous admitted carriers.
Mm-hmm.
Travelers, Casualty and Surety, I believe, is the name of one of them. Um, there's National Fire, right?
Mm-hmm.
There's a bunch of different, you might not recognize the actual name of the carrier because, again, that's just the entity that the businesses wrote through. The owner of that entity might be a company. That might be Geico. That might be
Mm-hmm.
Travelers. That might be Berkshire Hathaway, Nationwide, right? All of these big conglomerates, they have numerous different carriers or what we would call insurance paper to write the actual policy on.
So the insurance paper or the declaration, the DEX, I will see the logo of Geico or the logo of fire the ones that you say casualty.
Yeah, so you'll see the logo of Travelers,
Uh-huh.
but it'll state under the carrier name that specific carrier
Mm-hmm.
and its NAICS number.
Okay.
Right,
Okay.
for that. So Travelers has 1,000 different NICS numbers, right? It's not all the same number because depending
Yeah.
on what paper they write it on. So part of being an admitted carrier is you subject yourselves to rate and form filings. And if you want to write a risk, you want to write a policy, you
Mm-hmm.
have to maintain, you have to be within the bounds of what you filed for and rate. You can't go more than that, right?
Mm-hmm.
And part of the benefit of that is that if a carrier fails or goes into receivership, the state insurance fund will back a portion of all the policies that were written under the admitted carrier. A non-admitted carrier or an ENS excess and surplus lines carrier is a carrier that did not subject themselves to rate and form filing. They they have more flexibility on what type of coverage forms they offer. They have
Just
more,
just
yeah.
to form filing, you meaning to SL2, right? This the one
No, so
or
so
no?
an SL2 is basically a form that has to be filed every time you bind an excess and surplus lines
Uh-huh.
policy.
Okay.
So if I were to go out and win business and have it written on excess and surplus lines paper, I would have to inform my insured, my client, that it's written on ENS paper. They have to sign a little thing that says they're aware and what that means for them.
Mm-hmm.
And then that has to be filed. And so just taking a step back, so ENS,
Yeah,
right?
sorry.
They have more flexibility on coverage form, right? The typical coverage forms are what's called ISO or ISO forms. They're insurance standards. There are numerous different commercial and personal different types of forms that are standardized. And admitted carriers typically stick to those forms and have a few different other flexible forms that they got approval from the state. In the ENS world, your forms are much more flexible and are typically have a lot more carve outs and exclusions than a typical admitted form, right? So there's more flexibility on the form side, there's more flexibility on rate, right? A lot of more complex business is written on excess and surplus lines because the admitted carriers aren't able to charge enough to make it profitable. So the ENS carriers they're able to charge enough to be able to win that business profitably. And so those are the ENS. So when I go out for a quote from Travelers, if it doesn't fit into their admitted program, they might go and write it on ENS paper for me, even though it's
Mm.
still Travelers. They own a slew of ENS and admitted carriers below them. If that makes sense.
So take these kind of examples and let's talk about California, for example. Uh, I
Yeah.
will not ask and just go ahead.
So California, so typically personal lines have to be written on admitted paper by statute, right?
Mhm,
They cannot be written on excess and surplus. Don't count that as a blanket statement. That's just a generalization. They have to be
mhm.
written on admitted paper,
Okay.
right? And so the issues in the personal lines or the homeowners marketplace is very different than the commercial marketplace, but it's relatively same in theme, right? The admitted carriers are bound by their rate and form filings. They are not able to charge enough within what their filings will allow for to write business profitably. They're left with two issues, two possible ways to go about it. One, continue writing business unprofitably in the state, or two, leave the state altogether and hope to return at a different point in time. And it's important to keep in mind that when you're applying for your rate and form filing initially, you may have more flexibility than after you're already approved and writing there for some time, right? If I go with a rate and form filing with actuarial data to back up my ability to write at whatever rate it is per thousand or whatever my rates are, whatever my rating basis is, I may get more approved more quickly than if I'm already writing in the state and need to increase my base rates massively, right?
Mhm.
And so all of these carriers are already writing in the state, and California has a governing board that basically approves rate increases that won't allow for them to be increased enough so they can't write profitably.
And at Florida is the same situation?
Florida is a similar situation from the carrier perspective.
Mhm.
Another issue in Florida is that there's a tremendous amount of civil suits and tort filings, suits against carriers, um, to win potentially claims that are not true or false. They say that there's roofers going around everywhere knocking on doors and saying, "Hey, if you let us put a new roof on your house, we'll just file it through your insurance carrier," otherwise known as insurance fraud, right?
Wow.
So it's become to a point where carriers are paying out a lot of fictitious claims, um, and that's really impacting their losses, right? And their ability to win business or make business profitable in that state. Um, it's important to understand how carriers settle and pay out claims. When a claim comes in, it's different for liability and for property. Property is pretty much matter of fact, like, my house burnt down, how much does it cost to rebuild it type of thing.
Yeah.
But on the liability side, for instance, right, typically what will happen is there's a lawsuit, where there's a claim against the building owner and he claims it on his insurance, right? The insurance carrier is either left to fight it and take it all the way to court,
Mhm.
which I don't know if the last time you heard of insurance carriers really winning in court. Most people don't like to side with the insurance carriers. The
Yeah.
juries are not so insurance carrier friendly. The other option is to settle. And the longer that a claim is opened, the more money it's incurring, right? There's legal fees, there's claims administration fees, there's court fees, et cetera, et cetera, et cetera. So the goals of an insurance carrier by default are to close out a claim ASAP. How do we do that? Settle, right? So people might complain and say, my insurance carrier is settling too high too quickly, right? It's to a certain extent everyone's benefit, right? If you're not in control of your claims, the carrier is, right? They have to reserve money, right? They have to put money aside off of their balance sheet to pay out this claim now that it's claimed, right? They have to constantly be reevaluating their reserves to see if it's enough money, right? They have to hire claims counsel and have it claims administered, right? And adjudicated. All these things cost money. So let's close that out as quickly as possible, get those reserves back on our balance sheet by settling.
And it is especially in Florida?
Especially in Florida. I think they say something like that 97% or some ridiculous percentage of
Wow.
all all uh all I think, insurance fraud type things in the tort space kind of are down in Florida.
Okay, so let's move forward. What are the benefits of captive insurance?
So the benefits of captive insurance are threefold, maybe fourfold, right? Is one, you get true ownership over your insurance program.
Yes.
And that's start to finish. And if your risk hasn't been performing well, it's typically a motivating factor for people to have their risk perform well, to the extent it's in their control, right? Because now they own their risk or a portion of their risk. That's one. Two is that um is the benefit of having a profitable risk, right? If I'm spending $1 million in insurance a year and I only have claims of $200,000 and my expenses or the carriers or expenses are 40%, right? So 40% of $1 million is $400,000. That's $600,000 left to pay out claims. I have $100,000 in claims. That's $500,000 that the carrier is theoretically making off of me. If I can move that in-house and spend the same $1 million and have a lower expense ratio because typically captives have lower expenses. So 30%, so $700,000. That same $100,000 of claim leaves me with $600,000 left in my pocket in the end of the day. And that continues to build and compound surplus, right? It can be invested. It could be taken out as dividend, maybe even potentially loaned back theoretically, right? All of these different things, but the theme is the same as you're benefiting from your own risk. So it could be that You're going to spend the same amount of money, maybe even a little more money by going into a captive, but you own the surplus. Um, it could be that your premiums will be cheaper depending on the risk type and how much your risks cost in the commercial marketplace. Um, but you're growing surplus over time. Think about it as like a trust to a certain extent. Um, and that's a major benefit. And your captive could be reinsured as well. It doesn't have to just be bare. I don't have to take my entire insurance into my captive and say, whatever happens, happens. You can reinsure yourself like a normal carrier would reinsure yourself. You can go to the
Hmm.
reinsurance markets, right? And so you can do real good risk mitigation to kind of put yourself in a good position to benefit from your insurance.
So as a captive entity, I can go to reinsurance as to the reinsurance market and get fronting, get full risk, or that kind of situation. No? Okay.
Anything and everything you can imagine. You're
Wow.
an insurance entity now. You can go out, you can get a quota share, you can go get excess of loss, you can get ag, you can get clash cover, you can get all these different things for your captive to put you in a good position to succeed. Obviously, it comes as at a cost, right? Nothing's free in life, but you have the ability to approach the reinsurance markets as necessary.
So it sounds if, for example, let's take insurtechs. We had a lot of insurtechs that want to dealing with distribution and so on, but they also want to be in MGAs, for example, MGA, MGUs. So captive insurance is very relevant for that kind of insurtech, right? I will
Yeah,
not go to the carriers. I will not go to the companies. I will go to the captive market.
right. So yes, so we're seeing a tremendous amount of interest in captives and different risk retention structures from insurtechs. And it's not typically that we're going to see them skip the carrier route altogether because they're gonna either need fronted paper or some sort of reinsurance capacity either way. But it's more as a way to give them more optionality and skin of the game. So
Mhm.
captives, the best thing about them is that they're flexible, and the worst thing about them is that they're flexible, right? You kind of have to create and kind of, lay out what you're looking to do and what's best for you and your business, right? Which is not so easy when I'm used to going and buying a policy from travelers and they pretty much dictate the terms that it could be on, right? I don't have much creativity, but with captives, you have
Right.
a tremendous amount of creativity. And so it allows these insurtechs to go and either get a little bit of skin in the game. If they were going to be an MGA, maybe they're not a pure MGA and they have a little bit of risk retention there. Um, it allows them even the ability to be more marketable, right? MGAs, which are really just glorified distribution for carriers, right? And typically don't have any risk retention, but just get sliding scale commission or regular or just a normal high commission and maybe profit share. Um, they are not always 100%.
Just a sec. The Jets just okay went. Yeah, okay. Couple of combat jets, the F-15. Um,
No worries. Hope everything is okay and finishes up quickly over there.
yeah, I hope
Um,
so. Sorry.
yes.
Okay, go
So
ahead.
I was saying, so MGAs are not necessarily always so attractive to carriers, fronting carriers and reinsurers, right?
Right.
Especially when it's a new kid on the block. They don't have real insurance experience, or they might not have, operating experience in that business. They just have a good idea. Taking a portion of the risk in a captive makes it much more attractive to a fronting carrier and to a reinsurer. They say, hey, you're willing to take risk in this. That signals to us your confidence in this business, you know?
Right.
Um, and so we're seeing a lot of a lot of insurtech MGAs, even startups that are kind of adjacent to insurance, right? Think about maybe I can actually tap into the insurance of my client or my customer as well. And we're seeing a lot of that in the marketplace, where they're getting more educated. We're educating them. Um, they're getting more interested and they're viewing it as a viable option to really get their idea or their business off the ground.
you said in one of your tweets that I mentioned that captive property is hot. What do you mean by that? Why just captive property?
Yeah. So, so the property insurance market in the United States, um, nationally, right, nationwide, has been what we would call a hard market. And that means to say that rates are they're more punitive. They're higher rates than previously. There's less capacity in the marketplace. There's less appetite to write the risks, even if there was capacity, right? All of these things that kind of all have to do with each other in one way or another, but are also kind of separate issues as well. That's a nationwide theme. And then when you get into these catastrophe-ridden areas, you got Florida, you got coastal Texas, you got California, you got the Carolinas, you got all these tier one, tier two areas, wildfire and convective storm risk in the Midwest, right? All of these things are kind of just adding up to a rate environment that is harder and harder to place traditional business. And now compounding the difficulty of placing the traditional business and getting good rate for my traditional business has made property owners think, what in the world am I going to do? Because they're underwriting a property at X costs or expenses, operating expenses for their property when they acquire it. And their insurance assumptions are based off of the assumptions of insurance costs at that time, hopefully. And then in 2 years' time, their rates have effectively doubled or went up 50%, right? Their business, which is property, is no longer successful. It's not succeeding, right? It's not doing well, right? So what are they going to do? So they look for alternative solutions. And the main alternative solution that many are coming up with is some sort of captive structure within their property program. And again, that doesn't mean that they're self-insuring all of their property, because that would be a very silly thing to do. That is not risk management. That's just gambling, right? What they're doing is they're utilizing the flexibility of a captive to fit into the property program, to either do what's called a deductible buy down, or they're going to take a layer of risk, the primary layer, or maybe they're going to slot in a layer in a more expensive, higher level in their shared and layer program, or they're going to take the parametric risk, something like that, into their captive. There's different structures that they kind of come up with. But the theme is the same, that they're looking for alternative ways to finance their risk than the traditional marketplace.
You said something very interesting that what about all the captive entities? How they're looking about parametric insurance? Because I think it's very relevant for them to analyze, to manage their risk, their own risk.
So parametric insurance, so just so everyone's on the same page, parametric insurance is insurance that has a triggering event, it has a loss, and it has a defined or predefined payout, right? So while typical property insurance, for example, right, anytime there is any sort of loss that fits within the coverages outlined in my coverage forms, it will pay out based on the limits provided by my insurance and delineated in my coverage forms, right? Parametric insurance differs in that there's a trigger. It's not just any loss, but a specific trigger has to happen, and the loss payout is predefined and predetermined. So those triggers will change depending on the type of property or the type of scenario that I'm in. In coastal Florida, right, that will typically be a hurricane trigger. It will be winds of X percentage within a named storm, that sustain themselves for X miles per hour for over X time that cause a loss, something like that, right? And there will be a predetermined amount payout once there is a loss, $1 million, $2 million, whatever that may be. It's not the typical, building limit that you would on a normal property policy or like an AOP and a wind and something like that, right?
Right.
It's usually a smaller amount, right? But it's there. Typically, people use it to buy down, right? So like let's say they have a wind coverage deductible of 10% of TIV, right?
Mm-hmm.
So if they have a $100 million policy, meaning their TIV is $100 million, they have $100 million of replacement cost of real estate, and they have a wind that hits, a named storm with wind that hits one of their buildings, right? Even though it only caused $3 million in damage, maybe they have a 10% deductible on their TIV, right? So they're now liable for first $10 million before their coverage kicks in, right?
Right.
So typically what they'll do is they'll do a deductible buy down or they'll use a parametric policy as a buy down, right? And typically you wouldn't have a 10% deductible just, right off the bat. Usually you would negotiate to get up to a 10% deductible to lower your premium and then use the buy down to have like a net positive effect on your policy, right? On your premium that you're paying in.
And what about telematics products? For example, if I have commercial fleets or like tracks and so on, that I want all my fleet go on the captive insurance program. Okay, so I will give each and every driver, each and every truck a kind of application to his smartphone or a product that I will plug into the trucks to
Yeah. So for commercial trucking, for the most part, and even sometimes in commercial auto, pretty much most programs and carriers nowadays highly encourage or recommend telematics of some sort, whether it be true telematics with a service provider or cabin camera, something of that sort. And so if you're sophisticated enough of an operator to be going into a captive, yeah, that's a fundamental risk management, claims prevention type of, thing that you would input and kind of require from your drivers to make sure, that you're on top of that. And the reason is very simple, is that when it comes to auto, right? So in auto, or trucking, there's a few different lines of coverage. There's auto liability, right? That's what happens when I'm driving my car to someone else, right? The liability of that car. It hits someone, hits something,
right.
right? Property damage, all these things. Auto physical damage, which is the physical damage of my truck or my car.
Mm-hmm.
There's motor truck cargo. That's the actual cargo in my truck. There's workers' comp and OCAC, or occupational accident, the employment piece of the insurance coverage for truckers. Um, and then there's a slew of other things. Um, and then there's a slew of other things. And so when specifically when it comes to auto liability, the ability to have cameras and tracking to actually show and prove what happened is so necessary. It's so important and vital because you'll often have claims that are really not actually claims. They shouldn't have been claims. They're borderline insurance fraud when um, but when you have a camera to kind of prove what happened, the commercial trucker can actually be in the right. So an example is you have a truck that's getting off a highway on an exit, and a car swerves in to try to get into the exit the last minute, right?
Mm-hmm.
And it
Mm-hmm.
gets hit by the truck. If there was no cabin cameras there or dash cam, there would be no way to prove that the truck is not at fault. 9 times out of 10, the hit car is going to claim that against the trucker. The trucker is going to lose,
Mm-hmm.
right? Because they're a commercial trucker and
Exactly.
whatnot, right? But if I have cameras now to show that went from a 500,000 to $1 million claim down to nothing, right? Down to a
Right.
$10,000 claim, something like that, right? So it's so vital. Claims prevention and risk management, no matter what industry or subsector you're in, whether it's commercial auto and it's telematics and cameras, or whether it's property and having good property management and claims adjustment team, or whether it's med mal and it's having cameras in the hallways and good notes on your computer and good employment practices and whatnot. All of these things are so important when you're taking your risk in-house into a captive.
So as we near to the end, are there any final thoughts you would like to share?
Oh, I have a million thoughts I'd like to share. I feel like we didn't even delve far enough
I
into
didn't say
captives.
it. I didn't say it in the beginning, but you must follow insurance broker on the Twitter, especially on Twitter, because all your insights and your lessons about insurance 101, 105, 102, you are right now on 105, right? You have the
I think
tweets
so.
about insurance 105. Yeah,
Yeah.
it's wow, it's like reading a book about insurance, but in an exciting way. So keep with the good work, and but couple of thoughts, not all the millions.
I appreciate it. Yeah, I mean, insurance is a really interesting space that I never thought I would be interested in, and I learn something new every day. I think everyone in insurance can confidently say that there's something new that they didn't know the day beforehand that they figured out today, or they were realized they didn't know today. Um, but I'm excited for the future of alternative risk, as rates and regulations and become tighter and stricter. Um, I think there's a lot of opportunity both from a business perspective, for myself and the folks that I deal and work with, but to the actual underlying, businesses and operators out there in the field doing their own jobs and their own work, right? To kind of provide solutions to them where they feel they understand what they're doing, they own it a little better. I think the industry as a whole has done a very poor job at transparency and understanding, what does this cover, what doesn't this cover clearly? Why am I
Exactly.
charging you this amount? Why is it getting increased this year? Why is it not getting increased this year? What's the ecosystem look like? I think it's been a very poor job done. And ultimately, my goal is to educate people as best as I can.
Insurance broker, thank you very much for this educating conversation, and I will continue to follow you on Twitter, and we'll stay in touch.
Of course, thank you so much.
Thank you.